Hi, good evening, everyone. Thanks for logging in to our webinar on consistent compounders PMS. In this webinar, the aim is to give you an update on how things have progressed over the last 3-4 months. It's been 3 months since we did our last webinar for our clients, and obviously we are in very volatile times. Things are changing literally every day, every week in terms of sentiment, fundamentals, and various other aspects of the economy, of the portfolio, of the stock market. So I'll just give some update on that, and maybe after the first 20-25 minutes of my talking through this slides pack, I'll open up the floor for Q&A, and my colleague Salil will be happy to put across all the questions that you ask us in the interim over to me, and happy to answer as many as we can in this webinar. So let's kick off. So this is an update on the financial year which has ended, financial year to March 2020, where you can see in the table on the left the share price performance, and in the table on the right the earnings growth of Marcellus and CCP stocks. What is in particular of relevance here is when you look at the second last row, which is overall portfolio weighted average, you can see how the table on the left matches with the table on the right quite comfortably, which effectively means that if over the last 5 years or over the last 3 years, our portfolio has compounded at around 19% earnings compounding, earnings CAGR, the stock prices have also compounded at pretty much a similar run rate of 20-22%, including, and this is quite important, including FY20, a year in which obviously last 1 month of revenue was lost for many of our portfolio companies. More importantly, in the financial sector, which is roughly 25%, a quarter of our overall portfolio, in the financial sector, all of these banks and NBFCs that we own, they had done accelerated provisioning for COVID, which had very adversely affected their earnings for fourth quarter and financial year 2020 as a whole. Hence, it's quite a comfortable position to see 19% earnings growth in FY20 on a year-on-year basis, despite I would call them some of the accelerated hits that our portfolio companies took because of COVID, especially in the financial sector. Right? Had that not happened, had COVID not happened, we were actually running at a 30% plus YOY growth in FY20. And if you exclude the provisioning of the 3 lenders in our portfolio, which more pertains to conservative provisioning for NPAs, which have not yet hit them as on 31st of March. If you exclude that, then at least 25-26% earnings growth YOY is something that the portfolio delivered, which is pretty healthy, pretty robust. Against that, if our portfolio's share price movement has been 20% CAGR, 22% CAGR, it's pretty healthy, pretty robust, and doesn't talk about any sort of bubble or froth being built up into the valuations of these companies. Is fully supported by fundamental compounding, right? Also, not to miss out on the comparison with the last row, which is the broader market. So the alpha of earnings versus the broader market is roughly 18 to 20% over the last 1 year, last 3 years, last 5 years, right? Which is again a very comfortable thing to be sitting on. Because if we can ensure that no matter whether this is a good economic environment or a bad one, and last 5 years have been actually very tough, if we can deliver an alpha which is sort of 10, 15, 20% on earnings compounding compared to broader market, then healthy compounding of the share price in a way is a given, right? So that's the first slide. Worth bearing in mind. Let's move on. Now coming to the cash generation in a way, and the moats of these businesses. And also, more importantly, the reinvestment rate, of free cash that these businesses have thrown out. This table gives a summary on where we stand on ROCEs and reinvestment rate for all of our portfolio companies, and the weighted average, which is sort of 33% return on capital employed compared to 15% cost of capital, more or less, in the country, delivers a very healthy free cash flow. On top of it, we can also see that 66% is the capital reinvestment rate, despite the fact that one of the stocks in our portfolio, actually the 0% that you can see, and the star mentioned at the bottom. We'll share these slides in a separate email after the webinar is over, so you don't need to note down things if you want. But the 66% average reinvestment rate is a very, very healthy one for our overall portfolio. And hence, when you then look at what happened after the financial year ended, which is the COVID crisis, obviously, when the crisis started, we did a webinar, you might remember, where we talked about how no matter how deep or shallow the crisis is, it is highly likely that our portfolio companies will take measures like they always have during difficult periods in the external environment, where these measures will actually help them to strengthen their competitive positioning, and hence help accelerate revenue growth, earnings growth over the next, say, 3-4 years. A lot has happened on those lines over the last 3 or 4 months. So let me sort of take you through some examples, whilst summary of all these examples is there in the slide in front of you, in all these bullet points. The broader relevant trends, which are obviously emerging, are that first and foremost, the demand recovery for our portfolio companies is products and services has actually been a little faster than expected, given the intensity of lockdown that was implemented in the month of April and first half of May as well. Now that's quite heartening to see on the one hand, but at the same time, I mean, sooner or later we had expected the demand to come back at a healthy pace, because all the products and services that our portfolio companies deliver to the customers are of small ticket, day-to-day essentials, and hence not easy to be deferred or cancelled in demand. And none of the products and services that our portfolio companies offered can actually get substituted by something else, thanks to a crisis like this. So the recovery rates have been encouraging. They've been good, in some cases better than expected. The shifts that we are seeing as a result of this crisis are three. One, unorganized to organized shift is getting accelerated clearly, because unorganized players are finding it more difficult to manage working capital cycle, manage, let's say, growth, investments into growth thereafter, etc. And hence, I think this trend will only continue, where I think most categories would have seen X% of shift happening over the next 4 or 5 years. Now it might happen in 2-3 years. So there is clearly an acceleration in shift from unorganized to organized. The second trend is penetration of e-commerce as a substitute to the traditional forms of retailing in times of logistical challenges. Has obviously happened. Some of it will reverse, but a lot of it will lead to habitual changes in some categories, and hence you might see overall e-commerce penetration 2 years down the line being a lot higher than what it would have been without COVID in various categories where our product companies are present. And the third one is there are several company-specific initiatives which many companies in our portfolio are taking, which will only accelerate their market share gains over the next, say, 3, 4, 5 years. So let me take you through some of those examples. Yeah, so let's first look at things like, say, an Asian Paints, right? When it comes to supporting stakeholders, and Asian Paints very early on announced that salary increments to employees are not being curtailed. Likewise, Page Industries announced that there are no salary cuts or job losses that Page has taken over the last 3 months, despite the fact that Page owns on its own payrolls pretty much the entire labor workforce that is deployed at its manufacturing plants. Compare this against competition. For instance, Arvind, we heard in some media articles that there is a massive job cut, as well as salary cuts and curtailment of investments that the firm has decided upon. Aditya Birla Fashion, for instance, had to raise external money, and a lot of initiatives that they were deploying at the ground level pre-COVID, in terms of incentivizing channel, etc., had to be stopped. So against all of that, someone like an Asian Paints or a Page, very good examples of how they actually did stakeholder support of various types, more than what their competitors did. A few other examples that come to mind are Asian and Berger. They transferred cash directly into the bank accounts of painters. In Asian Paints' case, it was about 10,000 rupees transferred to 40,000 painters. A little smaller number in Berger's case. In addition to that, these companies did free sanitization of dealer shops, free COVID insurance protection provided, so on and so forth. But when you compare it against not just the unorganized companies, which obviously cannot afford all of this, but also the organized players like, say, an Akzo Nobel or a Kansai Nerolac, the free sanitization, the direct cash transfer was either non-existent or only a very, very small fraction of what Berger and Asian Paints have done. And that obviously not just helps build some sort of a goodwill with the channel partners, but also gives them the assurance that since disruptions and black swan events are becoming more and more frequent, 3 years down the line, 7 years down the line, whenever there is a next crisis, no matter what shape or form it could be, these channel partners are better positioned if they are on the priority list of an Asian Paints or a Berger, rather than on the priority list of some of their competitors. Right, hence a lot of market share gain potential emerges from such moves as well. Someone like a Pidilite, for instance, they converted all the loyalty points that the distributors had, or all the pending rewards that the distributors were yet to get. They converted all of that into Paytm cash and direct cash, etc., available to these channel partners. Someone like Dr. Lal Path Labs sort of helped renegotiate rentals downwards for collection centers of their franchisees in the hub and spoke network by getting into discussions with the landlords of these franchisees, which is something that we didn't hear of from many of their competitors, many of the competitors of Dr. Lal. So that's some example. There were also accelerated investments in infrastructure. For instance, Dr. Lal Path Labs ramped up home collections of samples in a very meaningful way, which has ended up becoming a big driver of differentiation between Lal and their competitors over the last 3 months. And I think this differentiation will only increase further over the next, say, 6, 9, 12 months for Dr. Lal. Someone like an Asian Paints aggressively launched sanitization as a service. Many of you would have already been aware of it, and the aim here is to help reduce the paranoia as soon as it can, and help kickstart painting as fast as it can be. Again, trying to gain market share before competition finds its feet in this sort of a crisis. And maybe when it comes to e-commerce as well, you can see how someone like a Page Industries, which has its own very efficient e-commerce website, not just relying on an Amazon or a Myntra or a Flipkart to distribute its products. Page Industries, I think in terms of benefiting from the accelerated e-commerce penetration, will be far ahead of their competitors, who to begin with didn't have any much of e-commerce a contribution to the revenues pre-COVID, and they didn't have enough of infrastructure available during and post-COVID to help benefit from the opportunity out there. So those are some of the examples. Moving on to how the impact of these initiatives is likely to benefit the performance grabbing opportunities of growth in future for our portfolio companies. So let me give you a few examples of already disclosed data points which suggest market share gains happening at a ground level. So a Berger in our portfolio, they mentioned in the month of June 2020 that sales for June have actually grown year on year compared to June 2019 for them, compared to say an AkzoNobel, who said that they were still at around 80% of pre-COVID level sales, and on a YOY basis. Kansai CEO was expecting to achieve 80% of pre-COVID sales by July 2020. Right, so those were some compare and contrast in the paint sector, clearly indicative of a Berger or an Asian Paints gaining market share from even organized competitors, not just unorganized. Similarly, when you look at the innerwear space, Page Industries mentioned that 85% of their labor workforce is back in factories by middle of June, compared to a dollar, which said towards the end of June that it is running factories at 50 to 60% of normal capacity and facing severe challenges around labor availability. Again, reflective of obviously strength of having owned the manufacturing workforce on their payrolls, and hence resumption or return to normalcy being much faster than that of competitors. Working capital cycles have interestingly reduced for our portfolio companies versus their competitors, and someone like both the paint companies, Pidilite, Page Industries are reflective of these trends. The next interesting point I can recollect is none of our portfolio companies have talked about delaying their planned capacity expansion and the investments behind future growth which they were previously targeting. And hence there's, I think, a massive opportunity to gain market shares, interestingly, not just organically over the next few years from unorganized as well as organized players, but also there are several areas, I think, of inorganic growth which might emerge. And whilst I won't be too excited about inorganic growth for many of our portfolio companies, one or two, including say someone like a Dr. Lal Pathlabs, which has demonstrated a very disciplined capital allocation towards M&A historically, whenever they've made such acquisitions. This company is also sitting on a large pile of surplus cash flow, and it has been waiting for a lot lower valuations to be available of the target franchises that can be acquired in the diagnostic space, because diagnostics is not a space where you can seek to build your brand over a 2-3 year period in a completely new geography. And hence, whilst Dr. Lal is very strong in North and East, if this sort of a crisis throws up opportunities for expansion in central India and southern India, etc., that will actually be a benefit of the crisis to Lal, provided obviously they acquire at decent valuations and they integrate these businesses in a disciplined manner. So all in all, in a nutshell, in the non-financials part of our portfolio, I think next 3 to 5 years of earnings growth prospects, they appear much brighter than what the earnings growth prospects would have been without COVID being there, and we are quite looking forward to it. So that's the non-financials piece. Let me quickly run you through the financials part of our portfolio. So to begin with, let's assess the strengths that our portfolio currently sits on. So on the liability side of the franchise, which is the funds that they have available to lend, we have in our portfolio India's most well-capitalized lenders with a very stable liabilities side of the franchise in our portfolio. The three lenders we have are Bajaj Finance, Kotak and HDFC Bank. If you were to talk about their capitalized part of the equation on the liability side, so Kotak has a capital adequacy ratio after their recent QIP of around 20%. HDFC Bank is at 19%. Bajaj Finance is at 26%. Three numbers which I think give a lot of comfort in terms of the ability of these firms not just to tide through the crisis but also accelerate lending on the other side. Also, not to mention that the entire liabilities franchise that these three firms have built is very, very granular. And for the two banks, it's more CASA oriented. Even for Bajaj Finance, it's deposits oriented. And these deposits, which are retail deposits, very sticky in nature, very low in cost. These deposits have grown by around 25% year on year for the quarter ending June. For HDFC Bank, they grew by a very similar run rate for Kotak in the March quarter, and FY20 Kotak's CASA ratio actually stands at around 56%. And for Bajaj Finance, likewise, a very strong deposits franchise, which if I remember the number correctly, there was a 33% growth in deposits in the quarter ending March for Bajaj Finance on a year-on-year basis. So very granular, sticky, low-cost deposits and growing at a healthy run rate. Again, a very important point to have in a crisis situation. When it comes to their asset liability management on the liability side, so Bajaj Finance has no ALM mismatches, no adverse ALM mismatches. It actually has very favorable ALM mismatches where it's the short-dated asset side, long-dated sticky liabilities. And someone like a BAF has actually been easily able to raise money from the debt market, and its liquidity surplus currently sits at around 15% of its entire loan book, around 18,000 crores to be precise. So that's pretty strong. What it gives obviously is a low cost of funding to help actually reduce the overall cost of liabilities, and helps a lot in expanding net interest margins in a time like this, when other lenders are actually struggling to even maintain liquidity coverage ratios, even struggling to retain depositors, struggling to sort of maintain their asset liability management under control. These three lenders in our portfolio, they have a very stable cost of funding and overall state of affairs on the liability side. Coming to the asset side of the portfolio, so to begin with, a very strong track record, historical track record of conservative underwriting, right? If I were to talk about moratorium, for instance, the moratorium book of, say, a Bajaj Finance, which is 15% of its entire loan book, down from, I think, 27% as of 30th April, 15% is as of 30th of June. I think this 15% number is probably the lowest amongst large NBFCs. When it comes to the banks, again, the moratorium book is amongst the lowest, single digits, if I remember correctly, mid-single digits for someone like an HDFC Bank. And both of them, HDFC Bank and Kotak, also have a very long track record of maintaining very good asset quality, alongside Bajaj Finance as well, of course. And hence, I think over the next 6 to 9 months, as NPAs spike up for the entire sector, no doubt they will go up for the three lenders in our portfolio as well. However, the increase in NPAs to begin with will be hopefully a lot more muted given the asset quality for these three lenders. And on top of it, I think you can also safely assume that at the other end of the crisis, the quality of the overall loan book for these three lenders will only increase further as competitive intensity reduces in the aftermath of this crisis. Not to forget, when it comes to provisions, very conservative and accelerated provisioning already done right? So, for instance, provisioning coverage ratio of HDFC Bank stands at around 72%. Kotak is around 69, BAF is around 60, and most of the banks, large banks, are in the 50 to 60 range, much lower than Kotak HDFC. Most of the NBFCs are much lower than what BAF is, and hence pretty comfortable on provisioning already done for potential NPAs that can come up in future. As a result of this, over the next 3 years, what the impact this crisis can have on the earnings growth potential for these three lenders is very positive. There will be enough capital available not only to survive but also to grow, right? Point number one. Secondly, when they grow, because competitive intensity will be relatively weaker, because competitors will probably be raising capital to survive, and these companies have raised capital to grow, you will actually see accelerated market share gains. Yeah. Net interest margins are likely to expand because cost of funds might not go up, and the yields on the loan book will remain very healthy, possibly if the competitive intensity plays out the way we are expecting it to be. And because of adequate provisioning, I think in the short term, over the next, say, 6 to 12 months, you should not see substantially negative trends compared to their competitors on a relative basis. In an absolute basis, there will be increase in NPAs that should be clearly expected here. So that's a bit of a summary on the financials portfolio. This is the performance. You can see for the month of for the period ending June 30th, 2020, where there are two ways to look at it actually. And if someone asks a question, happy to explain it using an Excel sheet as well. One way to look at it is look at the last 3 months. So YTD bar in the chart on the left, where we've delivered 9.3% versus 20% for Nifty. You can look at underperformance vis-a-vis Nifty 50, and think that we are not participating in the recovery of the markets, of the economy, etc. But then if you just see why it is happening, one of the reasons being a mathematical optical illusion. In the first 3 months of the year, of the calendar year 2020, in the first 3 months, because of the substantially lower drawdown, there is a mathematical illusion which is emerging, which gets nicely rectified when you look at the 6-month performance, where our 6-month performance is -5% versus -15 for the market, and 1-year performance in particular is 17% versus -11, positive 17 versus -11 for the market, a massive alpha. And this alpha of 28% for a 1-year period, for a 1-year period, is also reflective of the earnings growth alpha which I had shown you initially, which was here. Where is it? Yeah, so 19% for FY20 earnings growth for our portfolio versus -2% for Nifty, which is an alpha of about 21%, very similar to the alpha delivered at a share price level over the last 12 months. So I'll stop here.